Hello, everybody. This is Alan Elman, the Blue Collar Investor, welcoming you to this BCI podcast number 103 titled The Collar Strategy Using Longer Term Put Expirations. Now, when we use the collar strategy, we're adding a protective put to our covered call trades to enhance the downside protection. However, if we had to purchase these puts and use longer term expirations, that would reduce the per contract expiration cost dramatically. How will that impact our collar trades? In this podcast, we're going to be using a real life example with Sienna Corp, which trades on the New York Stock Exchange under the ticker symbol CIEN. Let's first define what is the collar strategy. Well, basically, it's covered call writing plus a protective put. So the first thing we do with this trade is purchase a stock or an exchange traded fund in 100 share increments because one option contract is the equivalent of 100 shares of the underlying security. Now, once we own the security and we're in a covered position, we then sell an out of the money call option, a strike price higher than current market value. That puts a ceiling on the trade. That means that if the price of the stock goes up to and beyond the call strike price, we cannot participate in any additional share appreciation because of our call contract obligation. So we buy the stock, we sell the call option, and the third step in the collar strategy is to purchase, to buy a protective put out of the money, which means lower than the current market value. That will then put a floor on the trade. So we cannot lose any more money if the price of the stock goes from current market value to below that put out of the money strike price. Now, the net position on the option side should result in a credit because we're doing these trades to make money, let's face it. So the cost of the put should be less than the premium generated when we sold the call option, resulting in a net option credit. The question in this particular podcast that we're analyzing is, should the per contract period cost of the put be reduced by using longer term put expirations? That is the crux of this podcast. Let's turn to a real life example with Sienna Corp as of 4/21/2020, when CIEN was trading at 44.04. Now, the 1 month, 5/15/2020, slightly less than 1 month, 45 out of the money call option, higher than current market value, had a bid price of $1.52. Once we sold that option, we are placing a ceiling on that trade at $45. So if Sienna goes up to and beyond that 45 strike, we can only participate in share appreciation from 44.04 to $45 or 96 cents per share. That is our covered call trade. Now we're adding a protective put to make it a collar. And that particular time, the 5/15/2020, 42 out of the money put, lower than current market value, had an ask price of $1.17. Once that put is purchased, we now have a floor on the trade. The price of Sienna goes below $42, we cannot lose any additional money. Now, the protective put had for the 42/1/15/2021, 9 months out protective put, same strike as the 1 month, but 9 months out rather than a little less than 1 month out. That had an ask price of $6.10. And had we purchased that put, it also would have set a floor on the trade at $42. So those are the two put expirations we're going to look at, the 5/15/2020 and the 1/15/2021. One is approximately 1 month out, and the latter is approximately 9 months out. Okay, let's break down the cost of the 9 month put in terms of the discount we're going to receive using a longer term put expiration. Well, the 1 month expiration costs $1.17. If we did that each month, it would result in a cost of $10.53 per share. Now, the 9 month expiration had a cost of $6.10. If we divided that by 9, it would come out to 68 cents per month, as opposed to $1.17 for the 1 month expiration. So right off the bat, you could see that there's a substantial savings. The 9 month cost, $10.53 versus $6.10, and the 1 month cost, $1.17 versus 68 cents. So there's no doubt that the monthly cost is much less with the longer term expiration. So once again, that 9 month difference of 443 resulted in a discount of 42.1% compared to the 1 month expiration. Very, very significant. But we haven't made a final decision yet. Let's really break down and evaluate this trade now so we could see the pros and cons of taking this path. Now we're going to be using the BCI Collar Calculator to have a look at the calculations using $1.17 as the put cost versus 68 cents using the 1 month longer term expiration if we divide it in by 9 months. And you could see, for those of you watching this podcast, we place the information into the white cells. For those not watching it, I will be as descriptive as possible. And we enter the information, the price of the stock, 44.04. We're going to be using an out-of-the-money call strike at 45 in both scenarios. And the call strike premium was $1.52 in both scenarios. The put strike was also $42 in both scenarios. But the cost of the put was $1.17 for the 1 month expiration, and the monthly cost is reduced to 68 cents for the 9 month expiration. And here's what the BCI Collar Calculator will let us know. The red arrow shows the initial return for the 1 month, 0.79%, which annualizes out to 12.09%. And for the 9 month put, which had a monthly cost of 68 cents, that more than doubled the initial return from 0.79% to 1.91%. That annualized out to 29.01%. So you could see more than doubling the initial structuring return. Now, the blue arrow, which will show the return if the price of the stock goes higher than that 45 call strike, you could see in the initial scenario using the 1 month put expiration of a 45% annualized return, 2.97% for the initial 1 month, versus 4.09 for the 1 month, which annualized out to 62%. Once again, very, very significant improvement. Now, the purple arrow, which shows the return if the price drops below that 42 put strike, you could see the loss is 3.84% for the 1 month put expiration versus 2.72%, much lower for the 9 month put expiration. So there's no question that reducing the per contract expiration cost of the put will improve the statistics regarding our returns. But let's now talk about the disadvantages of this approach to the collar strategy using longer term protective puts. First of all, the success of our trades depends on the share price remaining in a very narrow trading range for 9 months. How likely is that? It's possible, but probably not very likely. Now, our bullish assumption on the underlying security may change. I mean, we love it today. Will we love it 3 months from now, 5 months from now, 9 months from now? Maybe yes, and maybe no. That's another risk we're undertaking with this approach. It also, and this is important, forces us to maneuver through 2 to 3 earnings reports over the next 9 months. Now, this is partially mitigated because we do have a protective put in place, but still represents risk to the downside. Now, if the share price accelerates significantly, we maximize our covered call trade to the maximum return up to that call strike, but we lose on the put side. As the price of the stock goes up, the value of the put goes down. Now, assignment prior to put expiration may result in a loss because of the high initial cost of that protective put, another disadvantage to this approach. And finally, if the share price declines below the break even, we start to lose money. And that, of course, has application with all covered call trades, with or without protective puts. But I want to be thorough when I'm talking about the disadvantages of this approach. So let's summarize now. Unless we're avoiding ex-dividend dates where we may use 2-month expirations, my personal preference and what I recommend is to stay with 1-month obligations. Weeklies are fine as well. Although the monthly cost of the put will be more using these 1-month expirations, having the flexibility to reassess our bullish assumptions on a regular basis is much more important, as far as I'm concerned. Also, avoiding earnings reports is also more valuable than a few additional percentage points. So, all in all, evaluate the pros and cons of this approach and see if you come to the same conclusion that I just did. You may not. But as long as you understand the pros and the cons, whatever conclusion you come to is a valid one. As I always do, I want to brag to you about our BCI package. For those of you who want to know everything about option selling, covered call writing, selling cash secured puts, and other related strategies, the BCI package may be for you. It's our discounted package that includes everything. As those of you watching this podcast, it contains, you could see on the screenshot, 6 online video courses with downloadable workbooks, 6 calculators developed by the blue collar investor and found nowhere else, 5 of our best-selling books in ebook format, and our monthly, our annualized premium membership, which includes screening services, includes 4 reports, as well as a huge educational component. You can access this BCI package on our website. Those of you watching the podcast, just click on the BCI package link. For those of you not watching, log on. The URL is www.thebluecollarinvestor.com and click on the link in the top of the page that says BCI package. And it includes our never-ending and continuously ongoing training videos as well. So, folks, I want to thank you for taking the time to watch and or listen to this BCI podcast number 103, the collar strategy using longer-term put expirations. Folks, I hope you enjoyed this presentation, and most importantly, I hope you benefit from it. As always, this is Alan Ellman, the Blue Collar Investor. Take care, everybody.